Welcome to another episode of Mastering Finance, the podcast. My name is Nicholas Higgs.
And my name is Jarrell Hall.
And we have a great episode for you today. We'll be discussing how to raise capital for your business. We have two great guests to discuss it today. We have Robert Pantry, CEO and founder of Simplified Lending, as well as Liacarla Adderley, who's the Area Vice President for Business Banking for RBC for the Bahamas and Turks and Caicos. Thank you for coming today. Excellent.
Thank you.
Thank you very much for coming. I know you all are not the biggest fans of being on camera, and we really appreciate Jarrell and I taking the time to discuss this topic. And this is one of our most important topics. All entrepreneurs, I know at some point in their stage of business, they want to know how to raise capital. And so let's start. Tell us a little bit about how long have you been in lending? What's your experience in lending?
All right. Well, I'll actually start with banking. I've been in banking for too many years. I won't reveal my age, but in 2001, I became a management trainee. That would have been with Barclays Bank at the time. Shortly after that, Barclays and CIBC merged to First Caribbean. And as a part of that management training program, I got to go around the Caribbean for 2.5 years. During my last stint, which was an 8-month attachment in Belize, I was an acting relationship manager in business/commercial banking. And there, I guess, grew my love for commercial lending. So I've been there ever since. After the management training program was over, I was successful in landing a job as a relationship manager in Grand Bahama, then moved back home to Nassau, eventually became a senior relationship manager. And in 2018, a wonderful opportunity presented itself as the role you just talked about, which was Area Vice President, Business Banking for the Bahamas and Turks and Caicos for RBC.
Excellent, great experience.
It's been a while.
Been a while, for sure. That's a Robert.
Yeah, so I've been in financial services for more than 20 years. Started my career, spent most of my career at RBC. Like Liacarla, I spent some time on a graduate leadership training program. Prior to that, I worked in various entry-level roles. But in RBC, moved up to the position of Managing Director for RBC Finco, and then Vice President of Business Development for the Northern Caribbean. That covered the Bahamas, Cayman, and Turks and Caicos. And then moved over to Scotiabank as the Director of Retail Banking and Small Business for the Northern Caribbean as well, and that covered the Bahamas, Cayman, Turks and Caicos, and the British Virgin Islands. And then shortly after that, started Simplified Lending, and that's what we've been doing.
And so for our listener, we have a tremendous amount of experience. I'll say personally, in a previous role, we've worked together heavily, and Liacarla for sure was not easy on the plans when it came to funding, and Robert was definitely innovative in the ways we should structure deals. So this is going to be a very great topic, and I look forward to the things that we're going to discuss. And so just to let's start with let's talk key indicators. When should an entrepreneur seek external financing? At what point is someone ready to say, I'm going to take on external financing? And Robert, from a startup company perspective, and then Liacarla from an existing business perspective, what's your thoughts?
I think from a startup, an entrepreneur is ready in two different ways. One, when you have proof of concept, right? Someone has to be willing to pass monies to you for a product or service, and you got to be able to prove that. And then also in terms of the other element is really in terms of mentally, when someone is ready to go through the lows. We always see the highs of starting a business. People put a lot of marketing out and it feels good, right? But the reality of starting a business, you really start at the bottom. And I always ask entrepreneurs, are you ready to start from the bottom? Are you ready to do all the hard work? Are you ready to make the sacrifices? Are you ready to abandon all plan B and you only have a plan A? This got to work. So it's really from a mentality standpoint of when someone is ready to start a business and seek funding for a business.
So we know we'll go through a lot of different types of funding mechanisms. But for an entrepreneur, I have a small business or I have a huge vision. So this is let's say hypothetically like a casino or something, a hot dog stand. It's a startup business. At what point is it, is it the business plan is completed? Is it I have all my KYC? Or is it, I know you mentioned a proof of concept, but what do they need to have to say it's time to go to an FI? Because a lot of businesses, once they have the idea, they want funding. Sometimes once the business plan is done, they want the funding. So for you and your expertise, what point will a startup be ready to say it's time to approach funding?
I think a business is ready when they approve the concept, but I think what we see a lot of entrepreneurs, once they have the idea, they want funding, an external funding. And I always try to discourage entrepreneurs from getting funding too quickly, right? Because when you don't have proof of concept and you want funding quickly, you may have to give up some equity, right? And equity is your most expensive form of funding. People think, well, it's I get money, I don't have to pay it back. That's actually your most expensive form of funding, because when you do have proof of concept, you could always raise debt, right? And when I say proof of concept, can you generate? Is someone willing to pay you for this good or service? And I think that is the key part of funding, looking for to prove, in terms of proof of concept.
So Liacarla, even before we go to existing businesses, do you have any thoughts on the startup side?
He made valid points, right? Proof of concept. One thing that I think is important for startups is to start small, right? Because a startup is really considered a startup for at least 3 to 5 years. So you don't necessarily have to wake up tomorrow and say, hey, I need funding, right? So start small, again, establish a proof of concept, establish those historical data that any kind of lender or finance institution would look for. And then, start to have those discussions about wanting to grow and move to the next level.
Do you find that a lot of entrepreneurs want to start small? I mean, how do you even communicate the concept of start small when they come with these huge visions?
No, right? I mean, because at the end of the day, it's their dream, and everyone dreams big, right? I've never heard of anyone dreaming small, and so perhaps it's a little bit of a reality check to say, hey, maybe instead of opening up a boutique, in an actual footprint, sell out of the back of your car, do deliveries, and then establish your customer base, and then move to, acquiring all of those overheads that come with actually being in a storefront. So it's a challenge, and you have to balance it, because you have to understand that's their dream, right? But of course, us on the tail end, we look at numbers, we look at what we've learned, from seeing different scenarios and bringing that to the table and trying to balance it with the client's dream.
Thank you for saying something, Robert.
Yeah, so in terms of, as an entrepreneur, you got to think big. If you're not thinking big, then you're not ready to be an entrepreneur. But to Liacarla's point, you have to think big, but break down each action, task, activity incrementally. If it's going to be big, you got to move in incrementally. The process is just as important as the end state. So one of the things, even with an entrepreneur, in talking about accessing funding, you got to have even some savings. Don't care how small it is, you have to have some savings. Why? When you grow your business, you got to have that discipline to be able to save. You got to be able to retain some of the earnings and don't spend it all in the business to fund growth. So it's a lot about the entrepreneur itself. You got to be able to demonstrate savings, and then when you save, what you can do, you're going to think twice, right, before you spend that money, right? You're going to make a decision: do I spend it on marketing? Do I spend it on sales? Do I spend it on operations? Because now it's funds that you would have saved, and that is a natural at any size business. You always have those decisions to make. Sometimes if you just raise, if you borrow mommy or daddy's funds, or you just borrow it from the bank, sometimes you spend money, right, and then it doesn't allow for innovation, right? It doesn't allow for innovation. Most of the companies that were successful, when they were broke, that's when all of the innovative eyes, because like, how can I get this done without money or with limited money?
I agree. And you find a lot of entrepreneurs, they see that 10% down or 20% injection into the business. They see it as a hassle from the lenders especially. But there is a skin in the game is one side, but also showing discipline, the ability to take, this is your dream. How much are you willing to save to the side to say, I have this towards my business? And a lot of entrepreneurs don't appreciate that as much as they should. Now, when we get to existing businesses, at what point should they come to look for funding, external financing?
So for existing businesses, what we typically see is when they're ready to grow. So in most cases, they've started small, they've been successful, and so now they want to take their business to the next level, right? So of course, anyone going into a traditional lending institution, the first thing I think any lender is going to ask you is show me historical data, right? So going back to Robert's point about proof of concept. And so that's key. I say, and I preach it consistently, if you do nothing else, right, account for every dollar that you take in and every dollar that you spend, right? That is key. Whether you put it on a simple, QuickBooks, you may not have, the revenue to hire an accountant, but do some sort of internal bookkeeping. That's very important. And then back to the discipline, right? So another thing that's key is making sure that every dollar that you take in, you deposit it. I always talk about this example, right? Let's say you make $100 today and you have $100 in the bank, but that $100 in the ATM, and if you need $100 to pay for whatever, take the other 100 right back out, but make sure you show that trail, right? So that's the first thing. Make sure you keep proper records. And then, of course, like you said, if you're ready to grow, then show us how you're going to grow. Show us your vision, show us your projections, show us your assumptions, right? Don't just say, okay, I want 10 more buses, for example. What is that going to do, right? Have you considered the market? Like, will 10 more buses actually help you to grow your business, or is it just going to, add more capacity to the market that perhaps, consumers aren't ready to take on? So while, your concept may be great to say you want to grow, but is the market ready to actually accept that, right? Especially in the Bahamas where, we have a population of about 400,000, so, consumers are limited, and so you want to take that into consideration as well.
When you look at the historical side, are we looking for audited financials, compilations? What are we looking for, expectations for you're looking at a small business or a large business? We have listeners of all levels. What type of financials are we talking about?
So typically for micro, small businesses, depending on the amount they want to borrow, in-house statements may actually work. And then, of course, if you increase your financing, we may want to see reviewed statements where you have an accountant, somebody independent come in, you provide that that accountant with the numbers, and the accountant kind of vets that and provides a second set of eyes, right? And of course, if you're seeking substantial financing, of course, we're going to ask for audited statements.
Right. Is that a similar experience for you?
Similar experience. What we see is the entrepreneurs that's successful in raising funding, they have a good accounting with them. And I know, we all make this mistake as entrepreneurs when we look at our accountants as an expense. But the reality is your accounting can be an asset, right? They can allow you to raise funding when you're ready for it and when your business is ready for it to take advantage of growth opportunities. But they can also be able to attract investors who can put in equity, or even investors who will put in preference shares, which is the hybrid between the two. So that's the one thing I would encourage all young entrepreneurs: do not look at an accountant as an expense, right? Even if it's an outsourced accounting, as a part-time, your accounting is an asset to you. It's not an expense. So, and you want to start early. Don't wait and say, okay, after a year when I can afford one. Find the money, and they will help you find and access capital.
And that's I know a lot of we're speaking about it from the debt side. From the equity side, are those still similar requirements that you require from the debt side? Is it similar requirements?
Absolutely. The accounting, when you start talking about equities, you actually need the accounting even more, right? The debt typically is standard, right? With the equity, because now when you're dealing with investors, they need someone to, because again, some of the investors may not be sophisticated as a banker, and so they need someone to break it down for them to make sense of the numbers, and then also your accountant will also bring your vision into at a point where the investors, because sometimes you have the entrepreneurs over here, and you have the investors here, and you have the accounting somewhere in the middle, and the accountant is play that role, right? And we always tell the entrepreneur when you're in the room, try to let your accountant speak, because the entrepreneur got the passion and they got the drive, but sometimes it's a disconnect, right? And so that accountant is really one of the key, accountant or financial advisor. Now, again, I use that because everyone say, I'm a financial advisor. You need an accountant. When you're raising debt or equity, especially when you're raising equity.
So I know working with Liacarla in the past, sometimes you bring that entrepreneur and they're in the room, we can make $1 million, we can do this, and you're like tapping, like, hey, calm down, let's go through the margins, let's go through the numbers and let's make sure it's real. And I mean, all of us here have seen tremendously aggressive revenue structures, very aggressive expense numbers where it's just very minimal. You only need one or two things, not everything is accounted for. When we're looking at types of financing, what are common missteps you've seen entrepreneurs make when it comes to seeking funding, whether it's on the debt side, the equity side? I know we're going to jump into the types of financing there are, but what are the common missteps you see entrepreneurs make?
Well, you raised a very good example, right? About overestimating revenues and underestimating expenses. So typically what we would do whenever we get projections, we do something called a sensitivity analysis, right? So we say, let's assume revenues go down by 10-20% and expenses go up, right? And so once we do that sensitivity analysis, we come up with what we think is a more realistic number in terms of how your revenues, expenses, and net profits are going to look like, right? And we do our analysis actually based on those sensitized numbers. And that's very important because, like you said, right, again, it's their dream. And so obviously they want their dream to be successful, but reality happens as well, right? So your sales may not materialize as you expected. Your expenses may go up. I mean, if you just look at BPL, right? So what your BPL bill was last year is nothing compared to as what it was this month, for example. So all of those things we take into consideration, right, when we do our analysis. Other pitfalls, I would say, is not doing adequate market research, right? Really not scoping out the market. Is this thing built it and they will come? No, that's not going to work, right?
That's such a common thing person
yes,
say.
It's going to work, and no.
So we discussed market research in the last episode.
Right.
What, in this small country, where you don't have as much market research information out there, what's your advice to entrepreneurs gathering market research, whether you're in a service-based business, a product-based business? How do they get that information? What if this is an innovative idea that has never been in this country before? How do they get that market research to appease lenders on the equity or debt side?
Yeah. So I think one of the, I guess from a cultural standpoint, we are very secretive about our ideas and our plans, and sometimes we do it to our demise in terms of starting business. But you have to trust people. You have to find yourself some advisors and who may be in that industry, who have primary experience. And one of the things you will find, and I've found with entrepreneurs, they're very open with information as long as they ask. So you can go to someone who was in the industry, who may be in the industry, and say, tell me about it. And you'll find that they may be very open with you and say, hey, if I were to do this all over again, this is what I'll watch it for, this is, right? But half the battle is your primary research, just asking, Go out on the street. If you have a product, hey, try this, right? We don't do samples, right? The first day we start selling the product, we have a price tag on it.
Very true.
Give them the product.
Good margins on that
Yeah.
price. They even got lower price. They got margins on
No
that.
introductory price.
But ironically, they would have a budget of $10,000, $20,000 to spend on social media and marketing, right? But they can have a budget. They can cut that in half. Spend $2,000 on giving out free products, right?
Very good.
You automatically start to get a following, and right then and then, some of those people who try a product for the first time, free samples, they say, "Give me 20." So revenue started to come in, right? So the primary research, going out and talking to the customers, asking the customers, even before you launch, when you're in your initial stage, just go and say, "Hey, we're looking to do this. Would you buy this at this price?" Right? And we have to trust. Yes, there will be some folks, "Hey, that's a good idea, let me try that." But the reality is what you have to understand is not what you do. They may do the same thing you do, but it's how you do it. And when you do your research, you're going to end up doing it right, even though someone else may try the same thing.
So what we're discussing, is it the funder's responsibility to even tell the entrepreneur their market research is incorrect or that their numbers are too aggressive? Is that the responsibility of the lender?
In my opinion, I think the lender should be an advisor as well. So I would hope that prior to the client approaching for funding, right, the business owner, that they would have done their research. They would have had perhaps a mentor or somebody to guide them. But even if they didn't, even if, let's say, the lender still disagrees with what's in there, I do think it's the duty of a lender to provide some sort of advice as well.
Yeah. I think, to Liacarla's point, I agree, the lender would advise. And if there's interest, the lender may ask you more difficult questions, and you may think, okay, they're just trying to give me a hard time if they're not interested. But the reality is, whether it's a lender, whether it's an investor, if they are really interested, they're gonna ask you some hard-hitting questions, right? That's when they're interested. They say, "Well, thank you, Mr. Smith. Great, it's very interesting, and you'll hear from me." Chances you may not hear from them, right? But if they're really interested, they can critique it, right? You're gonna feel uncomfortable, but that's when you know, right? And you don't take it personal, right? You don't take the feedback personal. You accept it. That's when they're interested now. They may not be interested right now. Sometimes they trying to give you the feedback so that you could go get ready, and when you come back, maybe in 6 months, maybe after you prove the concept, right? But accepting that feedback is critical. And yes, every lender, every venture capitalist, we have an obligation to give that feedback whether we like it or not. And the reality is when we think back in our early days, even as employees coming up in the bank or starting a business, if someone didn't give us that real honest feedback, we wouldn't have been the way we are today.
And you mentioned not taking it personal. Entrepreneurs, a lot of my experience, take that personal. Some persons have been thinking about this idea for 10 years. Some persons even take it personal after they've been doing it looking at it for 3 months. And so for the listener, you have to understand that you're asking someone to give funding to your vision. They have the right to ask very difficult questions. They have the right to say no. And so they have rights to say, maybe you should adjust, and you have the right to say, I don't want to. But it's a give and take in a relationship that you have to build with your funder. They're not just someone who's supposed to be an open buy, and just based on you saying I want the money, they're supposed to say, hey, see the money. And so a common mistake that I've seen when it comes to fundraising is entrepreneurs at times don't respect the lender or the equity investor. They believe the idea person, the visionary, is weighed more. Me as an entrepreneur, I've started businesses and I've raised funds. I have an idea, I've written my business plan, and that's what my time was. The lender I'm going to, or the equity investor, has accumulated money over a long period of time via either businesses or savings. I have to respect them when it comes to approaching them. And so that's a major pitfall I've seen when it comes to entrepreneurs. Very confident when they approach the lenders. We already spoke about the business plan one. A critical one is not realistic expectations on terms. And so you will see sometimes, as they kind of see the smile just there, sometimes the valuation is extremely inflated on the equity side, or they want prime when it comes to the debt side. When it comes to that, how do you all address that when entrepreneurs approach you, not understanding the terms?
Ah, so many things I could cover off in that, right? Let's start with, when you say term, let's actually talk about the tenure of the loan, right? So let's say an entrepreneur comes in, he wants some financing to purchase inventory, right? Inventory typically, for most businesses, should turn around in about a year, right? So, but the investor, the client, he wants, let's say, a 5 to 10 year loan. That's a mixed match, right? Because you're going to turn over the purpose of your loan in about a year, but you're still going to have this debt on the books, right? So that's the first thing, right? Understanding, okay, if you're coming in for an asset that's considered short-term in nature, we're going to give you funding to match that period, right? And then there's this concept of risk, right? Pricing based on risk. Startups, for example, are considered high risk. It's no secret, right? And so any debt provided to a startup will attract a high rate of interest. So you're not going to be able to, as someone with a startup, to go in and negotiate prime, right? Because you don't have the proven track record. And so that's something that, entrepreneurs have to realize, that, interest rates are based on the risks associated with that particular funding. Other things to look at, we talked about interest rate, we talked about term, we talked about, let's talk about collateral, right? So sometimes, let's say if someone's bringing in real estate as the collateral, so let's say they have a house valued at $200,000 that they want to pledge as collateral, we discount that, right? So we're not going to give you 100% value of that collateral. And that sometimes is a hard pill for persons to understand, because, hey, if my property is valued $200,000, why can't you lend me $200,000, right? So there's a lot of things associated with that. We're not in the business of real estate. No lender is in the business of real estate. I'm sure persons would have heard that, right? And so but we don't ever want to get to the point where we have to sell the real estate that you're giving us. But of course, if we do get to that point, it's going to be costly, right? So even though your house may be valued at $200,000, by the time we pay, the realtor, the attorney, what have you, we're not going to net out $200,000. So those are the things that we take into consideration while we actually discount collateral.
I think that's a very important point on the collateral side. Entrepreneurs, current entrepreneurs or future entrepreneurs, with collateral, you have to understand that there is a cost to selling that asset, there's a cost to holding that asset, and there's a cost to maintaining that asset. So if I'm holding your house and I get vacant possession, I'm trying to sell it, but I still have to maintain the grass. I still have to, some entities have to actually maintain insurance. If you stop paying your bill, I have to take out insurance to make sure this house or this boat that you put up, I am protecting the value of it. And so that's a cost attached to it. So it's just not just going to be a one-to-one value unless it's cash. And so that's a challenge. So how do you see it?
I think I agree with Liacarla 100%. I think, and again, it goes back to proof of concept. A lot of entrepreneurs, when you prove concept, you may not have a real piece of real estate. You may not have equipment or expensive equipment to put up that will meet the margins, right? But when you have proof of concept, you literally can put up the shares in the company as collateral, right? Because now that you've proved the concept, it may not be big, you've proved the concept, then you can put up your shares as collateral.
Do you find there to be a common approach in a nation such as ourselves, where people lend based on the value of shares?
No. One of the reasons why we don't have a true secondary market for trading shares, that's one. But I think the creativity isn't there. Because we've seen and we've done deals where people would have put up their shares as collateral after they proved the concept, right? We've also done deals where people finance deals and acquisition with no cash, right? No cash acquisition, right? There's a lot of business owners, for different reasons, they would sell or own or finance their business, right? They may be getting up there in age, the business may be on a negative growth trajectory. They may have staff that they don't want to terminate. So if you have an entrepreneur who have a concept and who have the right vision to maybe step into another company, that owner says, okay, I'll hold my shares as collateral, and I'll hold your shares as collateral. And so you can quadruple the size of your company without advancing any cash. It may cost me Liacarla some interest income, right? But there's a lot of creative ways and innovative ways that you can do that. And a lot of these things, it goes back to my point, is finding an advisor, right? So when you find yourself an advisor, sometimes they would point you to these things. Or they may give you an advice and say, hey, do X, Y, Z, or that X, Y, Z don't make sense. You go, just that, and sometimes they already have something lined up with you. Or in some cases, they may already have a large client, a large purchase order that if you can get this product to this point, right? So there's a lot of innovative ways, because we understand that, yes, collateral is a challenge in this country. Even the speed at which you can perfect the collateral to fund. Sometimes, when you pledge real estate, that could take, 3, 4, or 5 months, right? And sometimes the business, okay, the opportunities can come and go on, come again and go on again.
Wait, it takes 3, 4 months for what?
To perfect, when you play.
For the listener who doesn't know what that means, for them to appreciate that, what does that mean?
Yeah, so when you pledge a collateral, the lender has to make sure that the property is free and clear and marketable. So you rely on your lawyer to complete legal work to confirm to the lender that, okay, you can accept this as collateral, but in the event that the client doesn't pay, you can go ahead and now sell the property. That takes time, right? That takes 2, 3, 4 months, right? Whereas, if you pledge in your shares, funding can happen within a short space in time, right? You still would need some lawyers, but it's just a shorter space in time.
I would say I disagree a little bit, but to your question, right? Is our market, or are we ready for that type of funding? I will say it's selective.
Yep.
So,
Yep.
In most cases, you won't find it in traditional lending institutions.
Right.
You will perhaps see some cases for very large companies that have been, around for a number of years and have really, really proven themselves, where a lending institution is prepared to take some of those shares as collateral. But, entrepreneur just starting out, or even, in the business for a couple of years, I would say it would be those non-traditional lenders who would look at that.
Yeah.
So what's very important is, another misstep entrepreneurs make is knowing which investor type to go to. We can talk about receivable financing, we can talk about just working capital funds needed, startup capital, equity, you have debt buybacks, you have so many different ways. How does an entrepreneur realize what type of investor they should be looking for? You're a startup business, I have a great idea. Who should be going to? The commercial banks, the non-traditional financiers? I should go into debt or equity or a blend? And advice is very important, as Robert has mentioned, but how does an entrepreneur ensure that they are seeking the right investor and speaking to them in the right language?
And at the right time.
Exactly.
Yeah. So I think this goes back to one of the common rules any entrepreneur should have is you need a business plan, right? And your business plan should be, for the next 12 months, for the next 3 years, next 5 years, next 10 years, right? So you need a business plan, and every year you should, update and refresh your business plan. That is going to tell you when and what type of funding you need, right? Because now, to Liacarla's point, you can look back at the historical financials, see how you're trending. You can look at, okay, predict, what will happen, okay? And if you only can see past 3 years, then, you probably need a short-term funding, right? But if you're looking to, let's say, expand, get your own warehouse, you may need long-term funding to get a commercial mortgage, right? So really, it depends on where that business is in terms of the life cycle. That would dictate the type of funding you need. In some cases, early on, you may need equity funding. Later on down, you may need mezzanine funding. And then, at some point, the banks will kick in.
Yeah, I think it also depends on the level of capital that you have, right?
Yeah.
So if you're a startup with basically no assets, I would say that traditional lenders may not be the correct or the appropriate avenue to go through.
She's being very nice. Being very nice. Possible. So entrepreneur, we want you to hit a real.
Yeah, okay. Because at the end of the day, most financial institutions will ask you for collateral, right? So, and collateral doesn't necessarily mean something that you have. You may have, you know, a mom, dad, cousin who buys into your vision and is prepared to offer their collateral, their property or some other real estate as collateral. But that's one of the main things I think you need to look like. What are you bringing to the table as a secondary source of repayment? Because as I mentioned earlier, using real estate as the example, we're not in the business of real estate, but we do look at real estate as a secondary source of repayment. So the first source of repayment is still going to be your cash flows, right? But if that doesn't pan out, let's look at the secondary, which would be that capital or that collateral that you can bring to the table. So if you don't have that available, then there are other options available to you. You can look at equity. Of course, with equity, that means that someone's buying into your business. They're actually acquiring shares. So what comes along with that is some level of ownership maybe, and you kind of lose a little bit of control, or you may lose a lot of control depending on how much equity is being invested into your business. Of course, Robert talked about the venture capitalists. Those can assist as well. There's the SBDC. So the SBDC, they have a number of I guess, various sources of funding that become available to an entrepreneur, including debt, right? So what they would do is they would actually approach a financial institution, and on the tail end, they provide a guarantee. So again, that guarantee covers the collateral piece that we talked about earlier that typically financial institutions would ask for.
So you actually answered my next question on that point is, how does an entrepreneur, we're all in finance, so we have this information. How does the person who has this great idea, but they don't understand, they're not familiar with all these innovative types of financing, or how to do evaluation, or how so far works, and it goes up and down. How do they get this information to really understand what to do next for their own business if they've not been in the financial field?
So, go ahead. Sorry.
I would just, mine is going to be short. I would just say, I honestly think that the SBDC is one of the best things since sliced bread. I mean, it really, and it's evolved over the years, and to me, it's a one-stop shop, right? So if you're an entrepreneur and you're starting out, you need help, whether it's a coach, a mentor, financial advice, help with the business plan, and of course, access to various sources of funding, I would say start with that.
Yeah. All of us here, I think, have worked along with the SBDC in some capacity, so that's a great recommendation for sure.
Yeah, so in November 2022, something happened in the world, and I don't think a lot of people understood what really happened, right? But something huge took place. It was the rollout of ChatGPT 3.5. Artificial intelligence has been a game changer for so many, right? People look at it from the academics, right? But for an entrepreneur who has limited capital, limited knowledge, limited know-how, ChatGPT is a game changer, right? An entrepreneur can go in and all of the stuff, the stuff Liacarla and I talked about, they can actually upload the video and say, hey, break this thing down for me, the way that I can understand, or my business is this, right? Tell me what they said and how this applied to my business, how I can go about it, right? I mean, any number of things, right? You need help with marketing, you need help with HR, right? Each one of them can be your assistant, right? You literally can run a professional business. By the way, you can put together your business plan, you can do your annual business planning, it can be your financial advisor. The only thing it can't do yet, but it's coming, to get you some coffee. But it's been such a game changer, and to your point, it really, again, it's the knowledge of the entrepreneur that can sometimes be the limiting factor. But when you add in artificial intelligence, that barrier has been significantly reduced. So I would always encourage entrepreneurs, even established business, you got to get it using artificial intelligence. ChatGPT is a great start. They just rolled out 4.0. Amazing, right? Amazing. So that is the best place for any entrepreneur, any industry, whatever you're doing, to start from.
I think it's a great point. And so, Jarrell,
Yeah.
I don't want to say your business on here, but you've written your business plan yourself sometimes. You have used external entities to write your business plans.
Correct.
And I think, was it Fiverr you used recently?
Not for a plan.
What did you use?
Not for a plan. That was more like for brand guidelines, something that's
So-
very simple.
So you've used a lot of different mechanisms to get information and develop your business, numerous businesses.
Yeah.
How do you find the best way to get information, to prepare yourselves, whether it's for funding or the development? How did you find, what do you use?
I mean, so I agree with Robert, right? I think AI has definitely leveled the playing field. I think you have elements like YouTube, for example, where, while you do have secondary information on there, there are quite a bit of reputable sources that you can reference. But AI has definitely leveled the playing field. From my vantage point, what I have used ChatGPT just to garner knowledge about various industries, try to look at what a particular industry is doing in a different country that may be similar in either landscape or environment, like the Bahamas, just to kind of get a benchmark of what the opportunity looks like. What I would sort of caution and say is that even though AI is very powerful, you have to still do your due diligence. Like we talked about this in the last episode about business plans, right? Persons go to AI, persons go to live plans to develop these business plans, and they just they don't vet it, right? And so I think that's very important. But no, I think AI definitely sets you in the right direction, right? And I think it also shortens the time frame and the runway to getting started in business. But a question I had though, on a point you guys mentioned, when we talk about funding, when we talk about AI and all of these different tools, what value do you guys place on the entrepreneur itself? So I know obviously, numbers sort of matter most, right? But do you guys look at, what's the makeup of the board of advisors, or what's the makeup of the investors that are involved? Does that lend any credence to, the decision to lend to a particular individual or individuals?
So, to lend or invest, the number one factor is the entrepreneur, right? I can tell you as an investor, if someone come in front of me and they say, Robert, I want you to fund my business. This is a part-time, I got my full-time job. Right. Okay, I'm done.
We had another episode where someone literally said that as well. I don't remember which episode, but someone said that exact line. So please, this is a reoccurring point.
Yeah.
They said if the person ain't willing to jump all in, why would I doing business
I think
with
it was
them?
Ethan. I think it was
Yeah,
Ethan.
I think so
Ethan
too.
Moss.
Sorry.
So if they're not willing to jump in and be all in, if you have a plan B in terms of having a full-time job, right? So I think that's important. So the primary is the entrepreneur, right? And then also if they have skin in the game, right? Or if they have something to lose. Why is that important? People think, well, it's just demonstrate, you got something to lose. No, it demonstrates that when things don't go according to plan, and it's 100% certain it will not go according to plan, right? All of the business plans tell you how far you went off, but it will not go. Will they cut and run, or will they use this as an opportunity to innovate? Will they use it as an opportunity to self-reflect and realize and say, what can I do differently? So it starts with the entrepreneur. And then yes, the board of advisors on the board is important too, because it allows for the entrepreneur to tap into other expertise that they may not have, and more importantly, experience. I always tell people, you don't have to feel to learn, right? And having a board of advisors and willing to listen to them. That's, some people
That's true.
And be willing to listen to them, right?
You don't pick your friends just to who can say yes, person to say yes with it.
Yeah, but just to add to that, yes, the board of directors, the management team, all of that is taken into consideration, when we're assessing someone, right, or a business, because you are the company you keep, right? And it's important that you have persons, like Robert said, that are experienced, that are able to provide you with that coaching and advice that you'd need to, to pivot you. For example, if there are things that happen, we know in businesses, everything doesn't go the way it's planned. And so having that experienced board of directors to impart that knowledge on you is extremely important. So we do take that into consideration. Obviously, yeah, it's not the leading factor, but there are a number of factors that we take into consideration. And that's certainly one of the important ones.
Yeah, and the reason I asked too is just simply because, and we've talked about this on the podcast as well, we found that there are tons of entrepreneurs out there who believe that they should go it alone. And I just ask that question to stress the point through you guys that it's important, like when you go ahead and you're pursuing entrepreneurship, you're starting a business, that it's important to, yes, rely on some of your capabilities, right? But also to rely on, like you mentioned too, the skills and strengths of others, because like Liacarla mentioned, that is considered in the whole funding formula.
Another key to your point, one of the mistakes a lot of entrepreneurs make is this theory of being self-employed. I'm the only owner of a business, right? If you are the only owner in a business, you will fail at some point. Yeah. You may build a good business, but if you're the only owner,
single
point of failure, and it has to come. Whether it comes by death, your business will. Whether it comes by, medical reasons, you can't run it, right? It's important for people, and you can build a good team, but it's different from someone you hire than someone who has shares or equity in your business, right? And I don't know one single billionaire who is 100% shareholder of their business. I don't.
A lot of billionaires don't have 50% shares of the company.
Exactly.
And so if you're going to build anything that's great, right, you will have to work with partners. They bring different expertise. When the ship is rocking, they may bring even just motivation to know that, okay, someone else is in this with me. And so that makes a difference. But I always tell entrepreneurs, you want, everyone says, well, I want to own 100%. I don't want no partners. Yes, it's don't get me wrong, it's difficult working with partners, absolutely. But if you're going to build anything that's significant and that's long term, you will have to bring in partners into your business, whether it's through selling shares or direct partnership.
As we close off the portion about missteps and mistakes made, one further one is a lot of entrepreneurs, they may create that plan and they don't discuss it with anybody. They don't really pitch it to anyone or to get ideas or to sharpen their sword. They just, this is mine. I'm going to show it to the funder now, only in person. I won't even let them have access to it. And so now they're in a position where they haven't really tested the market to see how persons feel about it. They may say, man, this area may not be a plan, this may be a B plan. And so if we move on to the next area is a client has now gotten a no. So this is an important topic. The client has gotten a no. How does a client change into a yes from where there's an equity lender, where there's an equity investor on the debt side? I'll give a quick example from my side. There was an entrepreneur denied. I mean, we had the beautiful plan, magnificent looking, financials are great, and every F is an existing business. Every FI said no, and we just can't understand it. Like, we put in great work, and we were just sitting around the office, and we're like, you know what? I know what we're gonna do. We're going to get a table, and we're going to write everything this company has done wrong. And we wrote 3 pages of just wrong. They didn't keep track of their financials properly. They didn't keep receipts correctly. And on the side of every issue was the solution and when it was done. 3 pages back in front of just wrong. The entrepreneur was traumatized. Do not say this. Do not tell places these mistakes. And you're right, we were their advisors and writers. So we knew everything. We knew where everything was hidden, and we just put it in there, and they got approved for that money. The investor was able to see that the thing that was buzzing in the back of my mind that was telling me no, you addressed that openly and said, we've made these mistakes, we had these inefficiencies, and we fixed that. Yeah. What other ways have you seen? How can someone translate a no to a yes from an investor? Or is there no?
No. I mean, and mind you gave an excellent example, right? So the starting point would be, okay, why was it a no, right? There's usually a reason, and in most cases, hopefully, the lender or the investor will share those reasons with the entrepreneur. Some of them, admittedly, may not be able to be fixed, in the near future. So one of the things could be, bad credit history. So that's going to take time to fix, right? If you've had bad debts, and now with the credit bureau, it's all public knowledge. So people are going to shy away from that. Banks, for example, they don't write you off completely, but typically banks would want to see a consistent number of years of you cleaning up your record and paying whatever debts you have on time. So again, that one may take a little bit of time. The one where, let's say, you didn't have proper accounting, yes, that could be fixed. Go back to the drawing board, dig up all of your receipts and put it together. Hire an accountant, spend some money doing that, get some proper records, and then, I think that in that case, it'll be more palatable in terms of giving it consideration. Trying to think of some other things. And then one of the things, maybe you just don't have the track record as yet, right? And so again, that takes time. Like, go out there, prove yourself, and maybe come back in a year or two. And that one, I think, is really the hardest one for an entrepreneur to accept, because he or she's ready now, right? Like, I want my money now. Like, this business is about to pop. But remember now, financial institutions, for example, they have shareholders' funds that they need to protect, right? And so, they have to properly assess the risk. And while it may seem like, they're being very conservative, but that's what they have to do, because they have to protect the shareholders' assets.
Yeah, so I hate to give this roundabout answer, but I'll give the roundabout answer. But so when you hear no, I think you need to extend your hand and shake that person hand and say thank you for the no. How you turn it into yes? Okay, that same person who tell you no, you ask that same question too. What can I do so the next time I come in front of you, this can be no? Now you just unlock. You just save yourself a lot of time. You unlock, right? But the reality is this, right? You should get scared when someone tell you yes, right? Because that's when it's a lot of responsibility when you take other people's money, whether it's debt, whether it's equity, whether it's anything else, right? It's a lot of responsibility, right? Saying no allows an opportunity for you to go and innovate. It allows for you to dig deeper, to Liacarla's point, dig deeper into your business, understand your business a bit more, and say, okay, how can I make this happen without that funding? Okay, when can I make this happen, right? So saying no, right? And any entrepreneur, successful entrepreneur, will tell you it wasn't for the no's, they wouldn't have not been where they are, right? So you really gotta be grateful for the no's, right? You gotta be grateful for the no's. And I tell you, right, if I didn't get some no's early on, I'd probably, you probably have less shares in your company, right? Because you can say, okay, I can go get this deal done. There's a lot of ways to get a deal done, right? Especially when you improve the concept. But you should be grateful for the no's, and that person who tell you no, just say, what can I do to get a yes? Right, and then talk to other people and say, listen, I approach, RBC, and RBC say, listen, no, okay, based on your experience, what can I do to get a yes, right? And again, I always want people, like, don't be too quick to take on debt, right? It's when you take on debt too early, it's a high probability that your business will fail, right? So don't be too quick to take on debt. So sorry again for the roundabout answer.
Excellent answer, Drew.
No, I mean, I think it's right. I mean, like, I've had experiences where you go to pitch an investor and you have some that say no, right? But I solely agree with your point, because that no, well, and I think it depends on the entrepreneur, right? Because I think you have some entrepreneurs, they get no's, and to them the world's ended and they should just try to find a different alternative. But I think you hit the nail on the head when that you have to find a way. And as an entrepreneur, you're literally signing up for no's, right? That's what you're doing, right? And so I think it's great for an entrepreneur to consider when that no comes, then what's the alternative? How do we innovate, right? And I think even to an extent, I've had investors dating back to college who said that they said no intentionally just to see what would happen, right? And some people play that game, right? Because again, like you mentioned, they initially, you are becoming a steward of their resources, right? They're finite resources, so you have to kind of consider those things. But no, I definitely believe that entrepreneurs definitely should consider the path they're signing up for. I think funding is a very crucial element of their business journey, and I believe that a lot of people don't take it serious.
So you know what no means, right? Someone told me one time, no means, Robert, no means next opportunity.
Yeah. Good point.
That's what no means, right? Right? So look for the next opportunity, right? And you come back to it.